Good afternoon to the viewers of this webinar, series of webinar on excellence in financial reporting. Very pertinent topic on the lesson learned from past years awardees and nominations, the best practices and commonly found errors. Specifically, today we are talking about this financial services other than banking and insurance sector. We have our chairman, CA Dr. Anuj Goyalji, the Central Council member of ICI. We have learned faculties with us, CA Gori Methi and CA Neha Bansal, CA Saloni Jain. Three girls today would be enlightening us on very pertinent topic, excellence in financial reporting. So I'm quite hopeful that with their vast experience in this particular domain, they would be justifying this topic and to guide us for ice breaking, what is expected from this session. The visioner of this series of webinar, my chairman, CA Dr. Anuj Goyal, who is the visioner of this series of webinar. He thought that he's chairing this committee since 2020. Although in 2004 also he was the chairman of the research committee. He is the sixth-term council member of the Institute of Chartered Accountants of India. His vast experience as a central council member, as a chairman, Central India Regional Council, as chairman of three prestigious institutions, CA, ICWA, and CSE. He chaired three of these institutions at Ghaziabad branch level. So his vast experience in this professional domain, as well as his qualification, make it very worthy that he is kind enough to spare some time for the audience and for even for me and the faculties. His presence matters a lot because his insight will be helping us to understand what is the expectation of, because he do meet with the industry, he do outreach, so he understand. It is his vision that he told us that we should have this series of webinar. CA Anuj Goyal is a member of all the three institutes. Now he is doctorate also, and he's law graduate, MCOM, and throughout of his academic career and the professional career, he was rank holder and very meritorious scholar. So there is a lot to discuss about C. Anuj Goyalji, but uh, I think he doesn't require any formal introduction and is known, he's in the heart of the CA fraternity because he is there in the council for last 6 terms. And so, in my best of my knowledge, each and every member of the profession across the globe who is a member of the institute, not only India, not only in CISC, across the globe, he is known to every professional, brother, chartered accountant, even in company secretary and ICWA also. So, with these words, I would request my chairman, C. Anuj Goyalji, for his words of wisdom and ice-breaking session.
Thank you very much, Dr. Amit Kumar Agrawal, our young and dynamic secretary of the research committee, and under his leadership, we are trying our level best to see that how we can really do something very concrete through this research committee, which is very important, not only for our profession, not only for our Institute of Chartered Accountants of India, but also for the society and in turn for the nation. And friends, today is a very important day that all three speakers, resource persons, are girls, and Institute of Chartered Accountants of India is trying its level best to see that how the best of the persons can be the chartered accountant. And we are very well aware that particularly in this part of the world, the girls are having the excellence over boys. And the Institute of Chartered Accountants of India's CA examination is not an exception, and girls are really doing wonders. So I welcome all the three resource persons, all the three chartered accountants, CA Neha Bansal ji, CA Gauri Mithi ji, and CA Ayushi Chan ji. And
Saloni Jain, sir.
Very important Saloni Chan ji. And on this very, very important series of webinars, which we have started on excellence in financial reporting, lessons learned, best practices, and commonly found errors. And you are very well aware that since 1955, the research committee is in existence, and since 1958, we are having ICI Award for Excellence in Financial Reporting. And we are trying our level best to see that how we can handle not only the corporates, but the chartered accountants who are working in the corporates, to see that how they can have the best presented accounts, and how they can try to see that whatever limitations are there, whatever deficiencies are there, how they can improve those deficiencies. So with that aim, we have started these series of webinars, and today we are having the financial services other than banking and insurance. You must be very well aware that as far as ICI Award for Excellence in Financial Reporting is concerned, we do compare apple with apple. We are having 14, 15 broad categories. And in the banking sector also, we are having banking sectors, we are having small finance banks also, and we are having the NBFC also, Amitji. And we are having, of course,
yes, sir.
And in addition to that, we are having the insurance sector also, so that the bigger financial institution can be compared with the bigger financial institution, and the smaller financial institution can be compared with the smaller financial institutions, and a fair competition can be there. So today we will be having financial services other than banking and insurance. And friends, you must be very well aware that as far as this research committee is concerned, we have taken n number of initiatives to see that how the Institute of Chartered Accountants of India, how the research committee can be a global leader as far as the research domain is concerned. And we are very well aware that unless and until there is extensive research, development can't take place. So for our profession, I think it is a need of our that we should have the best of the researches through the research committee of the Institute of Chartered Accountants of India in the accounting field, so that of course we can try to put our 100% for the development of our profession, for development of our trade and industry, and in turn for development of our nation. Friends, the global financial services market grew from $25,848 billion in 2022 to $28,115 billion in 2023 at a compound annual growth rate CAGR of around 9%. So the financial services is one sector which is growing very exponentially. Regulatory reporting is a critical activity for financial institutions and requires a concentrated effort from risk, finance, and other departments of the organization. Every nation's reserve system relies on the timely and accurate filing of report data by domestic and foreign financial institutions. The data collected from these regulatory reports facilitates early identification of problems that can threaten the safety and soundness of reporting institutions, and ensures timely implementation of legal corrective actions. Friends, the purpose of today's webinar is to share the knowledge about the sound reporting practices, not only for financial health, but include insight about a company's revenue, expense, profitability, and debt. And before proceeding further, I would like to bring to your notice, as you are very well aware, that since 1958, the research committee, through its subcommittee, the SEALD panel, has made sustained efforts to promote high-quality financial reporting through an annual award competition called the ICI Award for Excellence in Financial Reporting, in which entities are recognized for adhering to sound reporting practices. And I am very happy that Dr. Amit Agarwal ji is the Secretary of the Research Committee since 2020. And in spite of the pandemic, we could have the maximum number of entities as far as this ICI Award for Excellence in Financial Reporting is concerned. And now we are started the nomination do come. We do scrutinize at committee secretariats level. Then we are having technical reviewers, and then we introduced had technical reviewers, and finally the sealed panel is there. How so that any error can minimize in this plan. We are very well aware that as far as the research committee is concerned, it is the oldest technical.
There is some technical strengths at my chairman level. So in between he joins, I would like to add certain inputs.
Last 4 years, and during last 3-4 years, we have taken n number of initiatives. We are of course having ICI Award for Excellence in Financial Reporting, and last year we got 262 entries from various entities in different sectors. Then in 2020, we introduced ICI International Research Award, and I think it is the initiative of the Institute of Chartered Accountants of India and the International Federation of Accountants President, IFAC President, is the chairman of the jury since its inception in the very first year, second year, third year. We had the chairman of the jury who was none other than
Chairman sir, I think there is a disturbance at his end. So, Chairman sir, there was a disturbance. You would like to continue?
I think I have covered most of the things. We are having this ICI International Research Award. This time we are having it in the Gulf country. In Dubai, we are having very, very strong presence in Gulf countries. So we are trying to see that how we can really do something very, very concrete through ICI Research Project Scheme, through ICI Doctoral Scholarship Scheme. And we are trying our young generation of the chartered accountants to take interest in the research so that we can contribute not only for the profession, but also for the trade and industry, and in turn for the nation. So I'm really very happy that we are very, very successful in our endeavor to bring the research committee at the international forefront. We are now having the collaboration with various international organizations and the foreign accounting body. We are doing the joint research with various accounting bodies of the other parts of the world. And our chartered accountants are trying their level best to see that how they can come up to the expectation of the ex-president of the country, Dr. APJ Abul Kalam, who was of the view that the chartered accountants are the real partner in nation building. So through research committee, through the research projects, we are trying our level best to see how we can come up to the expectation of Dr. APJ Abul Kalam. We are contributing, we are handing over our research findings to the various state governments, central governments, and are ensuring that how the revenue leakages can be minimized and how the revenue can be enhanced. So I once again welcome our all the three speakers, our Trimurti, Gauri Methi Neha Bansal ji, Ms. Jain, on this very, very important topic on the financial sector. Thank you.
Thank you, Chairman sir, for your words of wisdom. And a few things I would like to add on what my chairman has said. Under his able guidance, this year we have contacted around 12 international institutions, the member bodies of IFAC, for collaborative research. and he spent a lot of time to have a collaboration with these body, including England and Wales, CPA Canada, Ireland, and many other institutions. So he's putting his heart and soul for how we can have a better research environment across the profession, not only in India. And you would be happy to know that the Institute of Chartered Accountant of India is now being recognized the pioneer in the research domain. It is worldwide accepted that the institute is a body which has taken lot of initiative in the research, and we are the flag bearer of this research initiative in accounting profession. So kudos to my chairman for his vision and 4 years of his consistency in that effort, because research is not a one time job, or continuous effort is required, and every day in your performance also one has to do research. This is one of the initiative which we have taken. So I would not take much time, because learned speakers are there. In between, I would be there to share my experience in the research committee with you people. But topic is pertains to excellence in financial reporting, and justification can be done by these three learned professional. Gori Methi ji. Gori Methi is a chartered accountant by profession. She is director as admin advisory, and she is postgraduate in management from Belgium, and she had completed her MBA from Veldic Business School, Belgium, and she is having around 10 years, 1 decade experience in various capacities as a chartered accountant, as an advisor, as a consultant, but she has expertise in financial reporting, and that too, she has in-depth knowledge of non-financial disclosures in excellence in financial reporting. I requested her to share her knowledge with other the audience. So I would request Gori Methi ji for her presentation. Over to CA Gori Methi.
Thank you, sir. First of all, I would like to place my sincere thanks to CA Anuj Goyal, sir. I think his dedication and hard work towards the research committee is visible, as the research committee has really come out with flying colors and what all it has achieved. You have you have already detailed out what the research committee has achieved. So I would like to also place my thanks to CA Dr. Amit Agarwal, sir. His contribution to the research committee is impeccable, I guess. And also the other members of the research committee, Neha, my co-speakers, Neha and Saloni as well, for joining me in this and giving me an opportunity to present my opinion on the topic for excellence in financial reporting. So I'll just start sharing the screen, right? And then we can begin this. We can start with the presentation. Yeah. It is visible, Neha?
Yes, it is visible.
Right. So now I think about this particular sector, Anuj sir has very well explained about how the sector is growing, how the GDP contribution is with respect to the financial services sector, other than banking and insurance, is growing at a very high growth rate, and it is so. Now I would like to first of all would like to bring your attention to the topic that about the financial reporting. So when we talk about the financial reports that are being prepared, so normally the financial reports are being prepared by the listed entities. That's what was happening a few decades back, that only listed entities were preparing the financial report. But nowadays, we see that a lot of private companies are also preparing are releasing their annual report. So although it is not mandatory for the private companies to prepare the annual report, but still they are developing this practice of preparing and releasing their annual report. So I would like to put this question to the audience, that what is the reason that the private companies are adhering to this practice of preparing the annual report, even though it is not mandatory for them to prepare these reports. So I would request the audience to please come out with their viewpoint on this question, that what is the reason that private companies are preparing the annual report.
No responses yet, Gauri. If
I
there is
I
anything,
think we should wait for 5
wait
10
for some
seconds.
time.
There is,
Right.
yeah, yeah, we'll wait. The screen is not visible properly because I got a message. There is a chat box. Is it visible or not?
So screen is absolutely visible.
Okay, okay,
You can just
perfect.
make it full screen.
Is that full screen only? Okay, okay. I see. Now it's better, I guess, right?
Right.
Okay. So just let me know if we get any answers on this question. Should I repeat the question? So before beginning the session, I would want audience to at least to answer this question, that why do private companies prepare their annual reports even though it is not mandatory for them to prepare
We have one answer from CA Rahul Jain from Delhi to bring transparency to their corporate governance.
I think it is very well answered. I think that is a perfect answer, C. Rahul Jain. Definitely, this is one of the reasons to bring transparency. And it is all. Any other answers that you received?
Not yet.
Okay. So then I'll just go ahead with this. And meanwhile, if we
So
receive
Gauri,
any,
we have few more answers. We have answer from CA Suraj Dahas from Mumbai for adhering to laws and regulation, from R. Aishwarya from Chennai. They will be planning to get listed. Right. We have these answers.
right. I think it is perfectly stated. So as Aishwarya has stated very perfectly, that because companies are planning to get listed. So normally the path that the companies follow, normally every company ultimately wants to get listed and to move to the next level of growth, right? So it is very well answered that too, before it goes for listing, some companies adhere to this practice of preparing their annual reports in advance because it takes time for the companies to adhere to these practices, and also it requires a lot of years of effort before they are able to publish able to publish their final reports once they get listed, because there are a lot of regulatory compliances, right? So before the companies decide to go for listing, they definitely start adhering to this practice of releasing their annual report. So I think the answers received are well in place. So definitely the companies release their annual reports. Private companies follow this practice to ensure transparency. Then there is one important reason that the private companies adhere to this practice, because they want to raise investments, right? And for investors, for better communication with the investors and other stakeholders, it is important to prepare these annual reports, because it is like a one way. It is the best way through which they can communicate with all the stakeholders. So when the companies are planning to raise investments, they start adhering to this practice. Then again, complying to all the laws and regulations that has been mentioned again in one of the answers, that they want to comply to all laws and regulations and avoid any penalties from regulators. So it is a single source of document through which a better communication can be established with the stakeholders, right? And also companies, there are companies who want to stand out from their peers, right? Because if other companies are not preparing their report and there is a private company which is preparing their annual report, then they will stand out from the other peers, and there is a differentiation in their communication, and this will help them to beat the competition to a certain extent, right? Now, moving on to the next. Now, when we are talking about the annual report, so first of all, I would like to give a brief about the different sections of the annual report, right? So broadly, the annual report is divided into 5 sections, right? Chairman's speech, corporate overview section. It is included in the corporate overview section. Then there is another section, management discussion and analysis section. Then there is director's report section. Then there is corporate governance and the financial disclosures. So normally a financial report is divided into broadly these 5 sections, right? So now when the companies are preparing their annual report, so what we witness is that the companies are dividing preparing their annual report as per these sections, but there are certain mistakes, certain common mistakes that are being witnessed in these sections. Now, why I'm talking about the non-financial section right now before this, because this time around the year, all the companies have frozen their financial numbers. The board meetings are being held and the financial numbers are freeze, right? So now the focus is on the non-financial section of the annual report. So I would like my audience to be aware about what are the non-financial sections, how the division is being done, and what are the common mistakes that are being found in the non-financial section. Because now the focus is on the non-financial section, right? So now, if we discuss about the chairman's speech, so the common mistake that is being witnessed in case of a chairman's speech is that the speech when I analyze so many listed companies reports, then one common mistake in the chairman's speech is that the chairman's speech does not mention about the company's 5-year plans, does not mention about the financial performance of the company. So normally what practice is being followed by the companies is that the financial numbers such as PAT margins, EBITDA margins, revenue figures, they all are mentioned in the CEO's speech, but they're not mentioned in the chairman's speech. Although in case of a listed company, it is mandatory for companies to mention in the chairman's speech about the financial number, although this was not mandatory for non-listed companies or private companies, but still it is recommended when because the first communication that is being done with the stakeholders is through the chairman's speech. That is the first communication. So it should definitely specify the financial numbers in the speech as well. So this is a very common mistake which is being found in the chairman's speech. Now, there is also in the annual report, there is a vision and a mission statement. So when we scroll through the annual report, we're like the vision and mission statement is a very generic statement, right? So the focus should be, because vision and mission statement depicts the company's vision, like in 1 or 2 lines, you have to depict you're communicating with the stakeholder what the vision is. So it just cannot be very generic. It has to be specific to the company, and it should communicate about the company's, it should strongly communicate about the company's vision and mission in the future, so that to establish that communication, right? Now, if we look at the management, so these are, and there are obviously, we are not discussing all the mistakes that are being witnessed in the chairman's speech. We'll just discuss a few common mistakes that are being witnessed in these non-financial sections. Now, if we move on to the next section, management discussion and analysis. So management discussion and analysis section is again mandated in case of listed companies by the SEBI LODR guidelines. But in case of listed companies, it is not mandated. Non-listed companies, this section is not mandated. Now, if we look at the composition of management discussion and analysis section, so management discussion and analysis section is composed of the economic overview, the industrial analysis of the sector in which the company is working in. Then it consists of the business overview, the segment-wise performance of the company. If there are no segments, then the product-wise performance of the company. Then it also includes about the internal controls and their adequacy, about the risk and concern, opportunities and threats. So these are certain sub-components of the management discussion and analysis section. Now, when we analyze the annual report of a non-listed companies, then it is a very common practice that this section is not being placed in the annual report. So there is no management discussion and analysis section. But the point is that these areas, for instance, the risk management, for example, the opportunities. So these areas are being covered in the corporate overview or in other sections of the annual report. So it is highly recommended for the companies to start preparing the management discussion and analysis section as well in case of non-listed companies also, because ultimately they are being included in other sections. Then so why not consolidate it into one single section of management discussion and analysis and present it in under that particular section in which it should have been placed. And also, it is the only section which establishes the communication with the stakeholders, because we talk about the economic overview, what is happening in the industry, then how the opportunities, how the company is taking advantage of the opportunities, how it is mitigating the risk, and what are their strategies, right? So this should be placed under the management discussion and analysis section only. Now, if we talk about the director's report, so director's report it is very common practice that the number of meetings, for example, the number of meetings of board is mentioned in the director's report. But it is a common practice to not include the date of those meetings. So it is mandated to include the date as well as along with the date also along with the number of meeting of the board of directors. So again, this is a very common mistake which is found in the director's report. And if we talk about other statutory reports non-compliances, then investor presentation and fund is being mentioned, right? But then the amount is not mentioned, which is being transferred to IEPF account. So a disclosure is mentioned about the transfer to the IEPF account, but the amount is also mandated to be disclosed in the director's report along with the disclosure, which is normally not included. Then in the corporate governance report, there are certain non-compliances like if a director is not attending a board meeting, then the reason for non-attendance of the board meeting should also be included in the director's report, in the corporate governance report. But then majority of the time, that reason is being excluded from the is not included in the CG report. So these are certain mistakes, certain common mistakes which are being found in the non-financial sections, which should be adhered to because it is as per the Companies Act, they are being mandated. So they should be adhered to. Now, the financial disclosures, common mistakes we will discuss as we move ahead in the session in the later slides. Right? Sorry. Now, I have discussed about the different sections of the annual report, and I've also discussed about what are the common mistakes that are being found in the annual report. But then there is an evolution that has taken place in the presentation of the annual report in the last decade, right? We all have seen the annual report since a long time. So now I would like to raise this question to the audience that what are the evolution that is being witnessed in the presentation of the annual report in the last decade? So I'm waiting for the answers. Neha, let me know if we get any answer.
Sure. No answers yet, Gauri. I think we can wait for a few more seconds.
I would repeat my question.
Gauri,
Yeah.
you can repeat your question. I think they were not
Right,
prepared
right.
to listen.
Right.
Yeah. I'll repeat my question. So we all, what is the evolution that is being witnessed? What is the change that is being witnessed in the preparation, in the presentation of the annual report since the last decade? So I would request all the audience to please answer this question, that what change you have witnessed in the presentation and what is the evolution that has happened in the presentation of the annual report in the last decade? I hope, Neha, the question is now clear. Hopefully we'll get some answers.
We are also waiting for that. But we do have some answers from here only.
So, ma'am, from the point of view of annual report, the evolution we are seeing is more of the transparency. There is better disclosures being given in the reports. Even the performance analysis of the last years is being given to show the trend that is therein for the better analysis of the stakeholders. So this is something that I noted from my side.
Right. I think you have answered very well, Neha. Definitely. One thing in which I would like to conclude your observation is enhanced disclosures that we are talking about. So definitely there are enhanced disclosures in the annual report that we have witnessed. I'm also expecting some answers from the audience.
We have few more answers. We have answer from D. Sankaran from Bangalore, non-financial matters like corporate governance. Then we have from C. Ankit Gadia from Mumbai, change in the format of reporting. Schedule 3 format has gone drastic changes. And obviously index reporting has also resulted in reporting changes. We have answer from C. Vikas Jain from Hooghly, more specific than generic. Then we have answer from C. Rahul Jain. Digitalization is there, cross-referencing, theme-based report is there. And we have one more answer from C. Sanjay Agrawal from Delhi, that lots of compliances and disclosures has been incorporated.
So I think the audience has very well answered all the evolution that has happened in the annual report. So definitely I'll move on to the next slide. So definitely there was one answer from one of the audience who has mentioned about the digitalization, cross-referencing, theme-based report. I think you've covered half of the content of my slide definitely. I completely agree. There is a lot of digitalization that has changed. So if I would request the audience to go and visit the Tata Steel report, the latest report that they have released. So they have completely revamped the entire reporting system. It is completely based on the AR and VR technology. So if we will scroll through that report, when you will visit, you will be astonished because it's like you are literally moving in the board report of the company. So it is being prepared in such a manner that it is completely based on. So digitalization has happened to that extent that the reports are using those AR and VR technologies into their reports. Then definitely reports are being prepared based on the theme. So now companies are experimenting so much with their annual reports. So they have moved to the next level with the preparation of the annual report. And for example, if you will check out the Future Generali's last year annual report, so they have prepared the entire annual report based on the Bollywood theme. So when you read that annual report, you'll not even feel that you are reading an annual report. It's more based on the Bollywood theme. So the experimentation has evolved to this level. So the annual reports have definitely evolved to this level. Then there's definitely integrated reporting. So integrated reporting has although it is not mandated, but companies are adopting integrated reporting into their practices, and because it's like we will talk in detail about the integrated reporting in later slides, but just to give a brief synopsis of the integrated reporting, so it is combining the financial and non-financial aspects of the report. It is basically integrating those aspects and communicating more about the non-financial aspects such as ESG targets. So BRSR reporting, they all are components of integrated reporting only. And then the 6 capitals relating to human capital, financial capital, social and relationship capital. So now the report, annual report is not just about the financial numbers, but it is also about the non-financial sections. It is also about the initiatives that are being taken on sustainability front, ESG targets that are being set by the company. What are the future strategies? So they are a complete package. It's like when you read the annual report, you get a complete overview of the sector in which the company is working in and what are their future plans and how they are adhering to the sustainability goals as well. And definitely increased transparency and that enhanced disclosures that was being mentioned by Neha are definitely one of the things that are being taken into account. Now we have discussed about the integrated about the annual report. Now these reports are also being scrutinized through the quality control mechanism. There are internal mechanisms and the external mechanisms. Right? So as PA Anuj Goyal sir was mentioning before about the ICI Awards for Excellence, so those awards are being selected based on the quality control mechanism of the institute, right? So that is the internal mechanism. So I would request Saloni to please enlighten us with the institute's different quality control mechanisms. So because I think she's a better person to explain about this, right? So please Saloni, go ahead.
Yeah, if I correctly understood, then I would like to respond this query. What are the procedure for excellence in financial reporting award recognition, the best entity? So I think there are 3-4 things. We at institute level, we have peer review board. That is the peer review of one practicing unit by other peer. Means one practicing chartered accountant is conducting a peer review of other practicing chartered accountant unit. This is one of the area. Another is quality review board, and then financial reporting review board. So there are various regulatory mechanisms through which we ensure this quality control, and there is a tax audit and quality review board that pertains to tax audit quality. Apart from that, in excellence in financial reporting also, So I would request Neha to describe this FRRB peer review and quality reward process. Before that, I will take 2 to 3 minutes to describe uh, what is the procedure of scrutiny of the annual reports or nomination received at ICI level. We have a rigorous process. We have a certain norms, and we have a technical reviewer panel with us. These technical reviewers do analysis on the based of certain pre-decided criteria. For enhancing the capabilities of these technical reviewers, we do conduct some training programs. Then there is a process. Who will be the technical reviewer? The fair understanding on Ind AS is one of the requirement. The practicing chartered accountant or the industry expert having a good amount of experience in that particular domain is another requirement. That after that, even after this eligibility criteria, there is a mechanism to choose the technical reviewer. That is, through training, we impart training, and then we ask them to present one sample report before the research committee, that these are the findings through scrutiny of these any of the report we assign them. And based on this, we choose the technical reviewers. Then these technical reviewers review the nomination so received. And there is a concept introduced in between, that is head technical reviewers. That head technical reviewers job is to review. So suppose we have 50 technical reviewers, so we will have head technical reviewers. So one head technical reviewer will again review the work of 10 technical reviewers. Then all these reports, after thorough evaluation by the technical reviewers and then head technical reviewers, it will goes to sealed panel. A certain reports, those who are scoring a certain marks, will be sent to the sealed panel members. But sealed panel member have full right to review again all the reports or selected reports. It's their prerogative. And then based on their evaluation, certain number of the entries are recommended to jury for their discussion. So there is a 4th year of the scrutiny process in the Excellence in Financial Reporting Award. So, and even jury has full right. Even they may consider sealed panel recommendation, they may dig into each and every nomination received. So it is their prerogative. They can do whatever. Sometime it may happen that they may ask certain queries to the sealed panel members, that why this particular entity is not qualifying or why this particular entity is qualifying. So there is a fair selection process. 4th year of selection process is there. So this is the how we ensure, and the very purpose of this award is because qualified report will not be placed before the sealed panel or technical reviewer. So only all good reports are going to be evaluated by the technical reviewers, the first stage of the technical reviewer. The very purpose is excellence in financial reporting. What is based on the nomination received. We are not certifying anything that this report is the excellent report, but based on the nomination received, out of that nomination, this report found to be best report or the best practices adopted. We are not certifying or attesting or assuring any financial data or non-financial data, just based on the document submitted by published document, this annual report, audited report submitted by the entity. We do decide that these are the best practices, and the very purpose is to bring to create an environment that the corporates must understand these are the best practices and how we can adopt these best practices. So this year, as I told you, that we are coming out with a document which will be describing what are the best practices and what are the commonly found errors. So this year, by end of this year, we would be bringing out this document. We are working on that. So that document will help the entities to understand the success stories as well as the certain shortcomings. So going through that document, it would not mean disclosing any entity name or not referring any entity name, but it is these are the best practices, these are the commonly found errors. Based on that, they can evaluate themselves where they lacked. And we are coming out with a very good document. Kudos to my colleague, CA Neha Bansal and Saloni. Those they are working day and night. They are bringing out one document that is the case history. A very good initiative has been taken by both of them under the able guidance of four of the experts. So they are working on that document, and very soon we will be coming out with case. We will be coming out with case studies. We will be coming out with case studies on best reporting practices in India, and we are joining hands with international bodies. Times to come, we are in process to come out with a document that demonstrating the best accounting or financial reporting practices across the globe and commonly found error. So, and we are also coming out with a document which will be describing the quarterly investors presentation and other things. So, but it's not possible without the active support of Gori, Ankit ji, Kuldeep ji, Neha and Saloni and his. Frankly speaking, Neha is the leader of that initiative. Thank you. Now over to Neha.
Thank you, sir. And I would like to thank Amit sir also for taking this the most commonly asked question regarding the ICI Awards for Excellence in Financial Reporting, that what is the process? And to move forward with this PPT, I would like to mention that before seeking what are the commonly found errors, we should know what is the quality control mechanism of the institute. We should first try to understand the hierarchy of the mechanism for better understanding. So to understand excellence, we should first know what is the quality control mechanism, and we have very important 4 boards of ICAI to monitor the quality control mechanism of ICAI. So I would like to give a brief about all the. So first one is the quality review board. The QRB performed various functions like making recommendations on the basis of review of quality of services provided by the members of the institute, including audit services, and to guide them to improve the quality of services and adherence to the various statutory and the other regulatory requirements. But after the introduction of NAFRA post 2019, so these function has been has come under the purview of NAFRA now. And the next board that we will talk about is Financial Reporting and Review Board. So FRRB is an important wing of ICAI that that works to bring the improvement in financial reporting practices and thereby promote investors' confidence in audited financial statement. It also works to provide independence to the board and to keep it separate from the disciplinary mechanism of the institute. The member with significant expertise in the field work under confidentiality covenants works here. Next, we have a peer review board. As rightly pointed out by Amit sir, peer review board is meant for the purpose of enhancing quality of professional work, thereby resulting into more reliable and useful audit and audit reports. And the last board that we have here is the Tax Audit and Quality Review Board. Basically, it works to review any report prescribed under the Income Tax Act 1961 and rules framed thereunder, and any report prescribed under the indirect taxation law, including GST, which are certified by a CA in respect of certain enterprises, with a view to determine to the extent possible compliances with the reporting requirements as prescribed in various laws. So moving on to the next slide. Yes.
Right. I think
Before starting
has,
with this slide, Gauri, I would like to mention that regarding an annual report, you have highlighted various non-financial factors that impacts a financial report. And since the importance of sustainability and ESG framework and other non-financial parameters are increasing, so these factors impacts the decision of an investors and other stakeholders as much as the financial factors involved. So I think we can proceed with this slide regarding the financial factors that which discloses top pitfalls in the financial reporting and the disclosures.
Neha, I would like to the various quality control measures This quality review board is the initiative of Ministry of Corporate Affairs. It takes care of all three institutions. So not directly coming under the jurisdiction of IC. It is a separate board.
Okay.
But
So I think it is a great opportunity for the audience to learn from the secretary himself how these boards function, and Saloni has very well explained that how these boards function and what are the roles of these different boards. It is important. Saloni has very rightly mentioned that it is important for the audience to learn about the functioning and about the quality control mechanism of the institute, because then only on these grounds only the report is being selected, and these grounds helps in establishing the excellent financial reporting practices. So definitely it is important for everyone to be enlightened with this particular subject. Now moving on to the financial disclosures. So financial disclosures, we will be deliberating together. Saloni, Neha, and I will be deliberating together on the financial disclosures. That what are the common pitfalls? What are the top pitfalls that are being found in the financial reporting and disclosures? Now, the major non-compliances that we see in the financial disclosures with respect to Ind AS is regarding Ind AS 107. So still there is a lot of challenge in adhering to Ind AS 107 for the companies, right? Now, if we talk about one of the prominent mistake of Ind AS 107, then there are three types of risk that is required to be disclosed by the companies. Right, there are market risk. So there are different types of risks that are being required to be disclosed. So if we talk about particularly the market risk, under market risk, there are three different risks which are required to be disclosed: currency risk, interest rate risk, and other risks. So whenever a disclosure regarding these risks are made by the companies, then they also have to give a sensitivity analysis of all the three risks that are being disclosed, right? But it is a very common practice in companies that we find that the sensitivity analysis with respect to the different market risk is not being mentioned. So it is mandated by Ind AS 107, but they are not being mentioned, right? And also, if we look at the terminology, the nomenclature that is being used in case of market risk, so mostly the companies use the correct terminology for the currency risk, for the interest rate risk, but for the other price risk, it is a very common practice that the other price risk is not being disclosed correctly in the financial disclosures. They are mostly disclosed as commodity price risk or any other terminology is being used, but the correct term for this is other price risk. So it is a very common practice which you can easily find in any annual report of any financial disclosure of the company. So this is something to be taken care of, right? And then in the same way, the sensitivity analysis is also mandated to be given for each type of market risk. So this is something which is mandated by Ind AS, but many companies does not follow to this guideline. Then there is a particular head, intangible assets under development. So it is a normal practice that the intangible assets under development is shown under property, plant, and equipment. But Schedule 3 mandates that this should be disclosed separately on the face of the balance sheet. So again, this is hello. Yeah, this is another prominent mistake that is being found in the financial reporting, right? Now, if we talk about the fourth point, then there is whenever any financial asset are measured. So there are three techniques through which it is measured as per Ind AS 107. One is as the amortized cost or fair value through other comprehensive income, and the third is fair value through profit and loss, right? Now, when the initial recognition is done and an asset is recognized, for example, at amortized cost, but due to changes in business models, due to changes in business models, some reclassification is required, right? So when that reclassification is being done, then it is again mandated by the Ind AS to book, if there is a reclassification, first of all, profit or loss will be booked. But if an asset is being recognized through other comprehensive income, that it will be booked in that. If it is the fair value through P&L, then it will be booked in P&L, right? And whenever there is a reclassification, then it is mandated to disclose the date of reclassification, detailed explanation of the change in business model, and a qualitative description of the changes, why the changes happen, and the amount reclassified into each category, right? So it is again mandated, but this is another common mistake that we witness, that it is not being disclosed whenever there is a reclassification. So initial recognition is being done, and in the subsequent recognition, if there is a reclassification, then it is not disclosed properly. The reason, the date of reclassification, the reason is not disclosed properly in the report.
Gauri, before proceeding
Yeah.
further, can you please expand your screen? We have a query
Right.
that the content, right?
Okay. Yeah, I'll do that. Sorry, I just slide got, I moved on to them. Yeah. Yeah.
Can it be expanded more?
More? What is the query?
Right, I think it is fine.
It is fine now?
Right.
Okay. So we'll move on to the next one. So Neha, you would like to take this one? Yeah. Hello?
Yes.
Yeah, Neha,
So,
you would like to take this one, right?
Right. So the commonly found error that we have in financial reporting is regarding initial recognition of trade receivables, which are measured at fair value despite no significant financing component as per Ind AS 115. So basically, the trade receivables are financial assets within the scope of requirement of Ind AS 109. And as per para 5.1.1 of Ind AS 109, at initial recognition, entity shall measure a financial asset or a financial liability at its fair value, plus or minus the transaction cost. However, those financial assets classified as fair value through profit and loss are required to be measured at the fair value. Further, as an exception to this principle, according to para 5.1.3 of Ind AS 109, financial assets in the form of the trade receivables shall be initially measured at the transaction price, which is defined in Ind AS 115. If trade receivable do not contain a significant financing component as determined in accordance with para 60 to 65 of Ind AS 115, it has, however, been noticed that in case of many companies in their accounting policies, it is erroneously stating that the trade receivables are initially recognized at fair value, which is contrary to the requirement of this Ind AS 109. So it should be measured at the transaction price and not the fair value. As far as the second query is concerned,
I would like to add something to this, Neha, the point that you mentioned.
Sure.
You have correctly mentioned that the trade receivables, if they do not have a significant financing component, should be measured at the transaction price, right? And there is also, because this is a very common mistake which is being found in the financial disclosure, so there is also an AFRA circular which has been published with respect to this particular guideline specifying a particular case that the trade receivables recognition is not as per the Ind AS. This is a very commonly found error in the financial disclosure. You can go ahead.
So Gauri, on the screen, if you will see, there is an arrow on the right side.
Right, which arrow? Wait,
pointing out to the right side.
Yeah.
Right, this one.
Right.
Can you please click on this?
Okay.
Right.
Yeah.
Right.
Yeah. Okay. I think.
So regarding that disclosure, also we can take one example as well. If a customer has paid in advance and the timing of the transfer of the goods is at the discretion of the customer, then in case of this contract would not have a significant financing component as per para 62 of the Ind AS 115. Consequently, this shall be measured at the transaction price instead of the fair value. So let's discuss about another commonly found error or the pitfall in the financial reporting and the disclosures that has been observed in the annual report of the many companies. That is, a company may fail to provide required qualitative or the quantitative info for Ind AS 116 compliances. Basically, para 51 of Ind AS 116 requires the lessee to disclose information that gives a basis for the users of financial statements to assess the effect that leases have on the financial position, financial performance, and cash flow of the lessee. And para 59 requires a lessee to disclose qualitative and quantitative information about its leasing activities, future cash flows, restrictions, or covenants imposed by leases and the sales or even the leaseback transaction. For example, if a lease contract contains termination or renew option, then the lessee can reduce its exposure by excising termination option or renewing leases with favorable terms and conditions. In this particular case, lease should be disclosed as the additional qualitative and the qualitative information. And other example can be if the lease contract have unusual lease terms, which is deviated from the industry practices, then the lessee should definitely disclose it. And another example that we can take can be if the lease contract contains contract requires the lessee to maintain particular financial ratios. It is a restriction imposed by lease or lessee that should be disclosed. This fact should be disclosed in the financial statement of that particular company. So, if you want to add on something to it, Gauri.
I think you have perfectly stated about this, but there is one common mistake with respect to the accounting policies in the lease that I have witnessed. So when we look at the accounting policy with respect to lease, then the classification is being done, but many companies miss about writing a disclosure related to right to use assets, right? So it should also be included in the accounting policy of the lease, and then also whenever a company is acting as a lessor, then it is important to mention about whether the lease is being classified as a finance lease or an operating lease. So this is also something to be taken care of while making the accounting policy. We can move on to the next one.
Absolutely. The next example and the next case that has been observed is debentures issued to holding and the ultimate holding companies which has not been disclosed, breaching the requirement of Ind AS 24. So basically, para 18 of Ind AS 24 requires entities with a related party transaction to disclose the nature of related party relationship as well as information about transaction and the outstanding balances. Further, it states that a minimum disclosure shall include following elements, which includes amount of the transaction, amount that has been outstanding, the outstanding balance that is, the terms and conditions, nature of the consideration, details of any guarantee received or given if there is any, and the provisions for the doubtful debt. But it has been observed that many of the entities are not disclosing all the components at the time of disclosure, and it has also been observed that the entities which have issued debentures and bonds to its holding companies and the ultimate holding company, they did not disclose the same or the entire information in their financial statement, which breaches the requirement of Ind AS 24. And since the member of the same group are considered as related party in AS 24, it should disclose the details of such kind of debenture issues or such kind of transactions.
Right. There is also one more thing that I would like to add with pertaining to this Ind AS 24, Neha. So you have mentioned about this disclosure, then there is an additional disclosure. So when in Ind AS 24, we mention about the details of payment to key managerial persons, right? So whenever there are payments made to this, the classification that is being done is normally short-term employee benefits, long-term employee benefits, termination benefits, share-based payments, right? So these are the certain classification that is being done. But it is a very common practice that is being seen with respect to the sitting fees that is paid to the directors, be it a related party or not a related party. It can be applicable in both the cases. So whenever a sitting fees is paid to a director, it is shown as a separate disclosure as per Ind AS 24 also when the payments are made to related parties to KMC. Right, it is shown as a separate disclosure, but it is highly recommended that the payment of sitting fees should also be included under the short-term employee benefits only, whenever we are talking about the related party or the non-related party. So it is this point pertains to both of them, but this disclosure is also being witnessed in case of related parties. That's why I mentioned it here. can move to the next. Also, we
Right.
can. Right. Sorry.
So can we take up the next case?
Right.
So another classic example that we have observed in the financial statements of many companies are like proceeds or repayment of term loans and purchase or sale of investments in subsidiaries were disclosed on the net basis in the cash flow statement in many cases. So para 22 of India's 27 states that the cash receipts and payment for the items in which the turnover is quick, the amounts are large and the maturities are low may be reported on a net basis irrespective of the gross. It should be reported on the net basis. For example, cash receipts and payment of short term borrowings which have a maturity period of up to 3 months can be reported on a net basis. Proceeds of the term loan and repayment of term loan cannot be reported on net basis as the maturity period is not short as required under para 22, and it should be reported on the gross basis. It is already mentioned in Ind AS. Similarly, purchase and sale of investment in subsidiary cannot be reported on net basis since the investment in subsidiaries are intended for longer period. So if you want to add anything here on this point, Gauri?
No, I think we can go ahead.
Okay, so can we move to the next slide, please?
Right.
So next, in some cases, it has been observed that the interest and dividend has been disclosed together instead of separately in the cash flow statements. So basically, para 31 of Ind AS 7, that is cash flow statement, states that the cash flow from interest and dividend received and paid shall be disclosed separately. Cash flow arising from interest paid and interest and dividend received in case of financial institution should be classified as cash flow arising from the operating activities, and in case of other than the financial institution, interest paid should be classified as a financing activity, and interest or dividend received, it should be classified as the investing activity. But in most of the cases, it has been observed that the interest and dividend has been disclosed together instead of separately, which is a requirement of Ind AS, and this accounts for the not following the requirement of Ind AS and the pitfall in the disclosure. So if you want to add on anything in this particular point.
I think when you mention about this particular problem, it looks so obvious that this is what should have been done, right? But again, it is surprising to see that it is a very common mistake that is being found. There is a very obvious thing that looks very obvious to someone, but then this is a very common mistake. I get it, right? And also, when we talk about the cash flow statement, then there is also one more thing that is being witnessed with respect to lease liability. So when we were discussing about lease, it is a very common mistake that the payment of lease is being mentioned together, like the principal portion as well as the interest is being clubbed together in the cash flow statement. Although Schedule 3 mandate is very clearly that the payment of the principal portion of lease liability and the payment of the interest portion of lease liability, they both should be segregated while preparing the cash flow statement. So this is another point. Right. We can move to the next one now.
Sure. So next of the error that we have found in the annual reports of most of the companies is basically related to the Companies Act, and it is like that the holding company granted loans to its subsidiaries without disclosing the purpose, and which is a clear violation of Section 186(4) of the Companies Act. So as per Section 186(4) of the Companies Act 2013, the company shall disclose to its members in the particularly the financial statements the full particulars of the loan given, investment made, or guarantee given, and even the security provided, and the purpose. The purpose is the main essence, that the purpose for which the loan or the guarantee or the security is proposed to be utilized by the recipient of the loan or the guarantee of the security. But most of the companies are not following this section, and they are violating the provisions of the Companies Act. So if you want to add anything here.
I think you have perfectly explained this one. Okay.
Welcome, CA Ankit Maheshwari, our star, some other professional engagement. So he's there with us. Ankit ji, Gauri has already taken non-financial disclosure part, and
Okay.
Neha is with this slide. I think she has started this financial disclosure. Just started. So, so would you like to take over now, or what should?
Sure. Amit sir, I would want to take it forward from here. But before
Yeah,
I take
thank you.
forward, I would just give I feel sorry for engaging slightly late in this discussion. We tried our level best to, come on time, but thank you, Neha, thank you, Gauri, thank you, Amit sir, for, holding this
Thank
up.
you, Ankit ji. Thank you for being late. We got three more speakers now.
Fantastic. Fantastic. And that's how all I just want to say, I'll not waste any more time of yours, and will want to straight away go on the financial part of it. Before we go on financial part of it, I would quickly want to deliberate on our four important boards, which I am sure Neha must have already covered, and their importance, be it the quality review board or be it the financial reporting and review board. These all pitfalls comes from FRRB. And when you look at FRRB's website, you realize what kind of commonly found errors in compliance of the technical standards are there. So importantly, my point here to bring the quality mechanism here is this quality mechanism only gives us advisory as to how do we avoid the common non-compliances of technical standards or professional standards. Whatever advisory comes on these slides come out of the experience of research committee and come out of the experience which we discover while evaluating annual reports of the company. With this, I want to start that there are certain things which FRRB observed, which we observe. One thing before we discuss about the interest and dividend together instead of separately in cash flow statement, all those insurance companies who are complying to Ind AS, right? FRRB issued a advisory because before that we used to nomenclate cash flow statement, and now with Ind AS coming, we call them statement of cash flows. So these are those small advisories which come from FRRB, an advisory where interest income or dividend incomes are still part of operating incomes, are such kind of pitfalls where even the larger companies fall into. This point specifically pertains to interest and dividend, which is disclosed together instead of separately in cash flow statement in certain cases. And as as I told you, one thing we should correct, even the bigger companies like Reliance in last year balance sheet was mentioning cash flow statement. However, the Ind AS has changed. We have transitioned. It has to be statement of cash flow. Two, we have to talk about how these interest incomes and dividend incomes needs to be disclosed, right? Especially for financial institution, because the sector, this entire webinar is specific to non-banking financial companies. That is why this report comes for you. So whatever interest paid and received, right, should be classified as operating activities, number one. For all other entities, interest paid should be financing activities. So here we are, in our case, it is a operating activities, right? And interest and dividend received should be separate. Interest, dividend paid is because being a activity which is classified from financing activities. So I hope with point one, it's a common problem. When we prepare our financials, a lot of thrust is given on disclosure of Schedule 3. A lot of thrust is given on how do we prepare a balance sheet, how do we put up significant notes to accounts and estimates. But a thrust needs to be given on the statement of cash flow also. it becomes a part of your entire financial statements which you are presenting, along with a lot of thrust on, before I discuss these pitfalls commonly, on the accounting policies, the significant accounting policies and estimates. I hope you are aware that now we are moving from significant accounting policies and estimates to material accounting policies and estimates. Can anyone in the audience tell me, what is the difference between significant accounting policies, which becomes a part to your financial statement, and a recent advisory from SEBI on material accounting policies? What do you sense is the basic difference? Because that is again a common pitfall. Neha and Gauri, in today's era, the problem is when you look at these annual reports, and Neha has the vastest experience looking at these annual reports, you will realize that maximum of these companies do nothing but starts reciprocating the language of India without thinking whether these policies are material enough for the company or not. So we will go on each index, look into the kind of accounting policy we should draft, what should be the material, what is material is what you know. I can't tell you materiality for your company, what could be a material accounting policy. So, but this paradigm shift, this shift from significant accounting policies to material accounting policies have come up. Has anybody seen that circular? And if somebody has seen, can anybody interpret for us what does this mean, significant and material? Neha, do we have
So
any answers?
we have an answer from Mumbai, Mr. Ankit Gadia, that material accounting policy should focus on part which is not already covered in the accounting standards.
Okay, so that is one part of the interpretation. So what is not covered by Ind AS should be covered if material, and I am somehow on your page. But the bigger problem, Neha, do we have another answer?
We don't have another answer, sir.
Okay. So with this, I want to bring on table one thing. Yes, you're right. Sometimes Ind AS does not specifically tells you, and that is why advisory like ITGC or all these advisories comes. Why do they come? Because sometimes it is an interpretational thing. Second, when you look at the concept of materiality, I told you that maximum companies are doing nothing, and their auditors also are just reciprocating what is mentioned in Ind AS. For example, what is the definition of property, plant, and equipment specified in your Ind AS is mentioned clearly. Nobody talks, what could be a property, plant, and equipment if you are an NBFC, and how do you categorize it into property, plant, and equipment if you are accounting for Ind AS 16. Similarly, when you look at the policies of intangibles, right, you realize one thing, that Ind AS, gives you an advisory about how do you classify your finite assets and infinite assets, right? When you talk about classifications of your finite assets and infinite assets, tell me how many NBFCs who are complying to Ind AS 38, Neha, tell me an answer, if somebody from the audience answer, who are categorizing their assets into intangible assets into finite and infinite and disclosing it respectively with the number of years these assets have been in use and the remaining life of these assets. So that is an appropriate disclosure. Now, I would say why I am reiterating all these things, because the common pitfall comes from here only. There might be an intangible asset which might be critical for your company, which might be material for your company, and which will require your attention in categorizing and in eventually wanting your stakeholders to know the remaining useful life for a finite asset, and for an infinite asset, what is the process of amortizing such intangible? So if how many NBFCs are complying to what I've just told? Or is it like that we mention what does India 38 says and we mention it into our policy without knowing that how critical our brand could be? As a NBFC, when you are operating into a segment where you open your retail outlets and start transacting a brand recognition, is it an internal generated brand? Is it a business combination? Or does it comes from an acquired service? That is what an Ind AS reciprocates. But when we write this, I think we lose the spirit of materiality and we just start writing what is mentioned in the Ind AS, even at the larger corporate sides. So my request will be everybody, every audience in this webinar should gear themselves for such kind of assessment of materiality. And if you are able to do it well, I am telling you, your common pitfalls automatically reduces, because now your policies are in alignment with the business practices you have been undertaking. So that is number one. So now I'll come again on common pitfalls which Neha was initially discussing, and then we discussed about the cash flow and how do we disclose the interest and dividend income. Other advisory which comes from FRRB is the holding company granting loans to their subsidiary without disclosing the purpose is violation of Section 186, subsection 4 of the Companies Act. Now, I would say related party transaction is the most commonly found error you will see. In related party errors, especially when you grant a loan to your subsidiary, right? What is expected to be given? It is not only the name and the quantum of outstanding of that subsidiary which you are expected to give, but it is also the full particulars of whatever investment you have made, any guarantees, any securities which are proposed to be utilized by the recipient. Entire information could come in synchronization. Another thing with related party, so one is pertaining to the loan component, another is about how do you, and our research committee is also coming out with a compendium on 1st July. It is expected to be launched on 1st July. We have tried to address this issue there also. My question to audience is, under the RPT disclosure, again a commonly found error, Neha, and this time we have tried that with Saloni we cover and dissect this error. Where do you disclose your sitting fees in RPT?
I would like to add I already explained them about the sitting fees.
It has
So let's
already been
also have
explained, right?
Okay.
But I
Okay.
think let's have a test of the audience with this question so that we know if how many of them were right. So I think we can still put
So because in maximum companies, when you look at the their KMP disclosure, you look at the bifurcation of short-term benefits, other long-term benefits, you don't find them. And not only you don't find those 5 heads, I'll conclude it if Gauri has already told it. You find commission paid to directors, sitting fees paid to directors, disclosed under this. And when you refer to Ind AS 24, it clearly says that even an independent director is a KMP for a company, and any remuneration paid to him has to be any sitting fees paid to him has to be in compliance with short-term benefits. So my point here is RPT is one kind of a disclosure where you find that maximum problems happen. And with NBFCs, specifically the loans which they are granting to their subsidiaries is something which should seek our attention. The third is about disclosing, not disclosing and recognizing the measurement of financial and assets and liabilities through some such as trade receivables, investments in equities, the borrowings which are displayed, and which is a breach of Ind AS 1 also, to some extent, it is a breach of Ind AS 109 financial instrument also. And my question here is, a commonly found error. Gauri, did you discuss how do you measure trade receivables?
Yeah, we discussed it in the previous
Yes.
slide. Neha deliberated on that regarding the transaction price. We have discussed that.
Regarding the transaction price, also, did you
Right.
deliberated that if you are writing that I am, calculating my impairment allowance based on, the expected life or expected credit loss, then in that case, you have to understand that these trade receivables, which while we say we are using simplified approach, a commonly found error is that companies are quoting that they are not doing their credit risk assessment. So did you discuss that part?
No, we did not deliberate
Not
on
covered,
this
sir.
particular part. Yeah.
Okay. So my question to our fellow members is, does using simplified approach, I am talking in compliance of Ind AS 109, I am talking about calculating an impairment allowance for a financial asset, and this is in sync with whatever common pitfall we have given here. Does using simplified approach exempts you to assess credit risk? Neha, look for answers.
Yes, sir. No answer.
And I'll show you 10 NBFC's report after this. My question is, using simplified approach exempts you to do credit assessment, risk assessment in case of calculating impairment allowance for trade receivables. My second question is, how many NBFCs here are disclosing provision matrix? Neha, do we have answers?
Not yet, sir. I think we can wait for 5 to 10 seconds more.
Okay. Any answers?
Not yet, sir.
Neha, so we are highlighting a problem where while company calculate their impairment allowance, put up this point that they use simplified approach for calculating their
Sir, there is one answer from CA Gaurav Gupta from Amritsar. No. Negative answer.
right. So that is the right answer, Gaurav. Gaurav, you are spot on. But the problem is, you look at almost all companies, and when they say that they are calculating impairment allowance on trade receivables, right? They use provision metrics. They say one way. However, they are not expected to assess the credit risk, and that is why they are using this lifetime method approach, amortizing it over a lifetime. Please note that. Please change these policies. You will find 9 out of 10 companies going wrong into it, while mentioning that we use simplified approach, hence we are not expected to calculate or track our credit risk. Then why do you give a disclosure in Ind AS 107? Ask this question. What we have written according to Ind AS 107? Because again, that is a common pitfall. I don't know whether you guys have discussed about market risk, and Gauri, you discussed the market risk and everything, right? So you discussed there is a credit risk, right? Interest rate risk, which we say, the credit risk, the foreign exchange risk. All these risks, you do sensitivity and you do it. So no point copy pasting a policy and saying that, since we are using the expected, since we are not tracking the credit rating, because we are using the simplified approach. Simplified approach gives you an approach in which you can amortize the asset over the lifetime. Also, another thing, you have to give the measurement and recognition policies of the financial assets which are mentioned here. Be it trade receivables, how do you measure it? Be it your investments in equity, be it your borrowings, be it whether you are taking it through profit and loss account, the fair values are through profit and loss account, or whether the fair values are through other comprehensive incomes, right? So all these things need to be a part of your entire accounting policy, and the disclosure of recognition and measurement should come up. Gauri, can we go on the next slide?
Right.
Okay, so these are certain disclosures, right, which are in compliance with. So this was pertaining to FRRB. Certain disclosures comes from FRQRB, which is the Financial Reporting and Quality Review Board of NFRA. And I would suggest all my audience to look into the reports what NFRA has issued. Not only their circulars, but the reports they have issued with respect to the companies will give you a lot of perspective as to how do you eventually, write things. I have another question, Neha, before we move on it. Do we need to have a specific policies as per Ind AS 109 for the bank and deposits which we keep and their impairment? Question is, generally company gives their policies of impairment in their subsidiaries, in their tangibles, in their intangibles. Am I expected to impair bank account also, or provide a provision allowance based on it, or the deposits which I have kept in bank? Am I expected to impair them? If yes, then what method? And then we move on these 3-4 points. They are expecting an answer.
No answers yet, sir.
Because lot of companies, I would again say majority of the companies are falling in this pitfall of saying that their bank accounts do not require an impairment allowance, or their deposits do not require an impairment allowance, because there is no credit risk associated with the money which is kept at bank. Such kind of disclosures we find in companies, specifically even in NBFCs also. When you look at it very closely, I would say an impairment allowance is something which you have to provide for every financial asset you hold. And the policy of this impairment allowance also needs to be mentioned clearly. Even if you hold your deposits with State Bank of India, or you hold your current or banking account with State Bank of India, you are still expected to make a credit risk assessment of it. If there is a credit risk rating change in the credit risk rating of SBI, it will expect you to make an impairment allowance based on the expected credit loss. So not that, instruments which appear to be risky, you are expected to make an impairment allowance. It is also about instruments which appears to be low risky. We need to measure risk for them. Forget trade receivables, where we use a lifetime approach. Even for the banks, even for the deposits, your policy should comprehensively cover all material instruments and talk about and have an impairment allowance and a provision matrix based on it. I hope my point is clear. Neha, do we have any answers?
Yes, sir, we have many answers in that regard. CA Gaurav Gupta has said, yes, impairment to be done on traditional method. And one more, Gaurav Mehra, expected loss credit method. And Vikas Kumar Jain, inflation-based discounting method to impair, maybe. And Gaurav Padar, yes, we need to impair them. There is a NEFRA guidance in this regard as well.
Absolutely. I think majority are correct, and the method is expected credit loss method. That is all, I want to communicate. Okay, so now we come on the scale-based regulation, and this would be exciting for NBFCs. When we talk about scale-based regulations, then there are certain disclosures which we need to make it as a part of scale-based regulation. So before we go on the technical part of it, let me go on slightly the non-technical part of it. Whether corporate governance report for an unlisted company needs to be a part of your annual report. I am repeating this question. If you are an unlisted company, are you and an NBFC, are you mandatorily required to print a corporate governance report, publish a corporate governance report? Neha, expecting some answers here.
Not yet, sir.
गौरी, आपने deliberate नहीं करा क्या?
We have deliberated on the common mistakes that are being found in the statutory reports, but not on this particular question that you're in.
Okay. Now, do we have any answers, Neha?
Not yet, sir.
I think there's a lag. So before these answer comes, right, let's talk about scale-based regulations. Let's talk about the, how do you disclose as an NBFC? How do you disclose your exposure in capital markets, right? When you look at it, you will realize that you have to disclose your underwriting commitments, which as an NBFC you have taken in respect of primary issue of instruments. If you have financed to brokers for margin trading, that also needs to be disclosed. Any exposure in alternate investment funds, all these disclosures are applicable if you are an NBFC, and you have to disclose it separately based on the scale-based regulation, which categorize all these NBFCs into different scales. Now, when we talk about intra-group exposures, so again, as I told you, all layers of needs to provide disclosure pertaining to intra-group exposure. Total amount of intra-group exposure is one thing which you need to provide. Total amount of top 20 intra-group exposure and percentage in each group also needs to be. So relatively, somebody should come to know, what are your top 20 exposure when you are going intra-group, right? And these have to be disclosed comparatively. So certain companies are disclosing it, but in an absolute way, or they are disclosing it over their financial reporting period. It is expected that you disclose it with the corresponding previous year also. Then we talk about the unhedged foreign currency exposure. Neha, do we have an answer now? Corporate governance report.
Sir, we have an answer from CA Gaurav Gupta. Yes.
Yes. So I
Positive
think
answer.
so we have a positive answer, and on the next page only we will disclose. However, disclosure pertaining to any unhedged foreign currency. Also, when you disclose any unhedged foreign currency, please go into the compliance of Ind AS 109 also, right? Mentioning your hedges and disclosing the policy of your hedges. Again, a common mistake you will find with all NBFCs, you have to disclose your fair value hedge, cash flow hedge. If you go on the interpretation of 109, lot of companies are just found to be disclosing their fair value, their cash flow hedges, and not the other hedges which are prescribed by Ind AS 109. So, as a part of accounting policies, please make sure that your hedge accounting is properly done, and also your unhedged foreign currency exposure needs to be right. Detailedly discuss, and how do you manage the foreign exchange currency risk. It is a compliance of this circular also, and Gauri, if you would have deliberated it on the disclosure of 107, then also I am sure you would have guided that how do you doing the sensitivity, and what are the policies to manage these foreign currency risk also needs to come up. The next is please.
I think that we have deliberated on the risk and the sensitivity, but not on the accounting policy. So we can take it here as well.
Okay. The next is about breach of a covenant, and again, nowadays NBFCs are required to disclose 100% instances if there is a breach of any covenant of loan, availed, or debt securities which we have used. These 4 things are there, and then I come on Gaurav Gupta's answer about whether a corporate governance report needs to be a part of your annual report. नेहा के पास बहुत सारी NBFCs अप्रोच करती है, ये बोलती है कि why no award for us, and I am sure गौरी ने भी इस पे deliberate किया होगा कि private limited company commonly falls in a pitfall just submitting their financial statements and expecting a award of excellence in financial reporting. The point here which I want to put up is that what Gauri and Neha already deliberated about mandatorily making things in your annual report, there are recommendatorily making or building your annual report on 4 5 fronts. I would want to go on the next slide. At certain cases, last year when I was looking at some NBFC's report, I realized that lot of companies are not giving their corporate governance reports, and then they expect that where do we lag. So obviously understand one thing: when you talk about excellence in financial reporting, institute will not come, or no technical reviewer or nobody will not come and check the calculations with which you have arrived. People will look into the methodology, the intent, the materiality of your disclosure and its compliance to the relevant laws. So non-listed NDFCs should make full endeavors to disclose the requirement, just like a listed company. And that is why there has to be a section of annual report which talks about the composition of the board, if there is a detail in change, if there is an absenteeism, if there is an attendance, the reasons for uh, resignation of directors. A lot of companies fail to disclose who was their lead independent director. Some companies fail to disclose how do they evaluate uh, their directors or their independent directors, and how do they and there's a mandate of doing an annual evaluation of all the directors and their qualifications and skills for better governance. So all these things needs to come, and if there are certain non-compliances, this needs to be specifically reported under this section. Last, again, a non-financial part. It pertains to disclosure of complaints to customers, right? And now with SBI disclosure, all NBFCs in all layers are required to include some additional disclosure with regard to their customer complaints, right? Uh, earlier, Gauri, if you recall, we were only reporting the number of complaints, the total number of complaints. Now the thrust is on, just like any mechanism, any redressal mechanism, the thrust is on the number of complaints NBFCs are able to resolve, right? Details of I am unable to even read it. So details of
Right.
maintainable complaints, if you can zoom in a little, I don't know how others would be reading.
Right. So it is mentioned that the disclosure should mention about the number of complaints that has been addressed, along with how many number of complaints, like the total number of complaints, along with how many number of complaints have been addressed, right?
Right.
So,
And right. So
right.
this entire provision talks about details of maintainable complaints, right, received by the NBFC from the Office of Ombudsman, right, and then the advisory, how it was mediated, number of uh, awards unimplemented within a stipulated time, right, other than those who are appealed. So top 5 grounds, importantly, top 5 grounds of complaints received by NBFC from customers. So that similar nature of complaints should come as a part of your disclosure, and the stakeholder should come to know, this is your gray area, and this is the area that where company also needs to come to know that they need to work about. So that is where we can go on the next slide. So all these disclosures are coming out of scale-based regulations, right? With Ind AS coming and advisory, lot of advisory issue, we have incorporated certain points which talks about the transitioning of Ind AS and what kind of impact it had. I still feel now it remains only relevant to those companies who will go into the transition of Ind AS, and rest, all those who have transitioned have already seen these changes, would help me to deliberate on these changes. But just I think the major change which I feel was the valuation of liabilities, right, specifically towards post employment benefits, when all these NBFCs transitioned, and when as an NBFC, you will transition. All these areas are something which you should look about, be it your recognition or reversal of deferred tax, or be it your measurement of investments or assets at fair value through P&L account. Right. All these things will have an impact. Gauri, we can, quickly move on the next slide. We discussed about the provision of impairment allowance and the usage of the method and 109. We already had a discussion, right? A lot of things are deliberated on recognition of upfront fees and income from loans, right? And where a loan was dispersed, how do we recognize the upfront fees, right? While we were at accounting standard, the upfront fees of customers are recognized in P&L account at the point of transaction. While when we transition to Ind AS, right? So the methodology of recognizing this is completely changed, because it is very difficult to distinguish the point of transaction in this particular case, right? And initial amount is recognized as interest income using EIR method, and further then income on loans and financial assets and liabilities are classified as per amortized method, which we discussed as per 109 also, while we were talking about measuring our financial assets and financial liabilities. So there would be other reasons also, but primarily I'm saying we have gone through the transition. All the private limited companies or the companies which are intended to go for listing or scaling up their operations, right, and now need to make their compliance with Ind AS. Gauri, we can move on the next slide. So I think the last topic of today would be the external mechanism and the LODR compliances. I think we have enoughly deliberated on all these issues. We can move on the next slide. I'll just take the critical things. I have one question here, Gauri. I have one question.
Right.
Listed companies, to all the listed companies who make their investor presentations, right, and also publish their audited financial results with them. My question to you is whether you are mandatorily required to make an investor presentation. That is my question one. My question two here is, if you are required to make a mandatory presentation, then should you include your audited results in it or not? I hope, Gauri, my question is clear. Neha?
Yeah. Yes, I think.
Right.
Yes, sir.
But
Okay, you want to add something? Okay. Question is whether listed companies are mandatorily required to make investor presentations or not. Question number one. And question number two, if yes or no, whatever. If yes, then whether the quarterly audited results also needs to be published with them. Do we have any answer to this? For all the
Waiting for the
participants from
answers, sir.
listed companies. I think we have talked about corporate governance report, contents of board reports. Everything has been covered.
right.
Only thing is, this is an important thing. This is an important mistake which a lot of listed companies are doing. If there's an answer to it, fine. Else I'll move fast because we are left with almost last 10-12 minutes only.
No answers yet, sir.
Okay, so for all listed entities, NBFCs, please note very carefully. There is an advisory issued by NSE on 15th March stating, right, that if you are publishing your quarterly results, do not club it with your investor presentation. Your auditor's report, your results should come separately from your investor presentation. Lot of companies are doing this common mistakes, because when Neha and team evaluates for this excellence in financial reporting thing, they give weightage to the quarterly results and the timely uploading of quarterly results also. Also, I would want to say to all the audience, I think from mid of the July, most likely 13 July, we see the revision in LODR circular, and there is a lot of trust which is given under Regulation 30. So you see the timing. I hope you're aware about what are the changes in Regulation 30. Otherwise, I'll request Neha to mail to the participants if somebody wants that. There's a major change in Regulation 30 highlighting the materiality concept, right? So today, if there is something material, earlier it was a discretion of board. In this circular, they have come up saying, they've set up the criteria as how much percentage of net worth, how much percentage of turnover, and within 30 minutes of board meeting, you are expected to inform if it is an internal decision. The timing, there is a lot of thrust which is given on the timing of compliance of LODR guideline. My request to my learned audience would be that, just look at those amendments. The entire compliance structure being a listed entity post this amendment will change, and your secretarial teams needs to thoroughly work about SOPs pertaining to the compliance of these amendments in Regulation 30. I would want to go on the next slide. If we have any answers for the quarterly results, I think not yet. We have,
So
we
we
have,
do have
we have
answers. Yes, we do have certain
Okay.
answers. See, Gaurav Gupta, yes, both things mandatory as per LODR. And we have, I mean, most of the people have given positive information regarding this.
Okay, but I hope I am clear to Gaurav and everybody in at that side of the table that this cannot be cumulatively uploaded. This needs to be uploaded separately. Also, I have again said, please look into the amendments which are coming on LODR Regulation 30, right? Regarding the timing and the materiality of the entire circular. Can we move on the next slide, Gauri?
Right.
Let's go ahead. So here are certain things, right? As I told you, when you look into the commonly found error, and so you will realize that, we have categorized these errors into where do we find maximum errors and which index we find maximum errors. So you will realize that majority of the errors pertains to the asset side, be it your current assets, be it your non-current assets, right? Still a lot of errors you find in cash flow statement. When we talk about other disclosures, we tried to deliberate on each issue. We can go on the next slide, Gauri. So I think this is an eye opener. This comes from FRRB for NBFCs, that which are the top circulars of non-compliance, and still our Ind AS 1 seems to be the presentation and disclosure. The basic spirit of entire Ind AS comes from Ind AS 1, and that needs to be more compliant. Yes, there are errors pertaining to 108, 109, 107, and we have discussed everything, be it your sensitivity analysis or be it, how do you measure a financial instrument, how do you initially measure it, how do you subsequently measure it, how do you eventually have an impairment allowance, how do you assess the materiality pertaining to it. So all these things needs to be taken care. We also realized there are certain things, be it your Ind AS pertaining to lease, be it your Ind AS pertaining to government grants. I think these policies we should look into. In government grants, maximum companies disclose, the policy of accounting a government grant. But when you look at the Ind AS, it talks about disclosing two things: not only the policies of government grants, but how do you present it? How are you presenting it? Presenting your government grant should also be a part of your significant accounting policies and estimates. Can we move on the next slide? Okay, so I think Neha, we will just try to conclude this. We have covered majority of the aspects, but one thing which I specifically feel is that there is, while we talk 10, 15, 20 years back, a financial reporting actually meant the financial statements of the company. We have evolved ahead, and the kind of compliances which catches each company requires an effort to be on all sections. And that is why I requested Gauri and Neha to, by the time I join the session, if they can take up the non-financial part, because I still feel, as reviewers also, as technical reviewers also, your non-financial part constitutes a lot of weightage. I am sure Gauri would have discussed about having a value-added statement, and how do you disclose a value-added statement. So all these things are important. Second, what slide which came to our heads and here is about the forward-looking framework, which has a lot of weightage now. So your adoption of integrated reporting, and unfortunately, not many of the NBFCs are correctly or quantifying their integrated reporting framework. When we talk about integrated reporting framework, we talk about all those 6 capitals which IIRC has described, be it your financial capital, be it your intellectual capital, be it your human capital, be it your social capital, be it your relationship capital. All these capitals, everyone who is adopting integrated reporting framework, Gauri, you must have observed, are talking about
Right.
them. The problem lies
Definitely.
in two important things. One, the entire model of value creation, which is the intent of having a IIRC framework. From where do you take this input of capitals, and how do you eventually go on reach to the output? And the process, the value creation process of this entire framework is what is very important. So try to quantify it. Just don't say that this is intellectual capital. Tell what how what is your brand value. Tell how many patents you developed, how many copyrights you developed in a year. Tell all these things. So you have to, the process of quantifying this capital is important. Going back to the entire concept of excellence in financial reporting, with non-financial is important is how forward-looking your report is. Like SEBI mandated, top 500 companies to come out with a voluntarily integrated report. How many actually adopted it? And when they adopted, once you adopt this framework, please note that you can't move back. So once you are adopting an integrated reporting framework, you have to present it integratedly. Gauri, did you discuss that point that, with integrated reporting coming up, our MDAs have been compromised?
No, we did not pay specific attention to that because we were supposed to discuss it in this area.
Okay.
But
So,
yeah,
so,
we did not.
so just one in one line, uh, with MDAs, right? While integrated reporting framework coming up, the MDAs have been compromised. People don't talk about their risk management policies. People don't talk about their human resource policies. People don't talk about their opportunities and threat. And sometimes they inculcate this in integrated reporting framework. Please make it separate. It is a MDA is a compliance to LODR. It can't be replaced to IR. IR में कुछ रह जाएगा चलेगा. MDA में अगर statutory report है, you can't miss to work on MDA part of it. So that is another thing. So it constitutes another marks. And then comes your financial statements. And when it is about NBFCs, then I am sure the compliance of the technical standard is important. The compliance of the Companies Act is important. The compliance of the disclosure of your accounting policies and material accounting policies. So when Neha and team reviews it, they look into that aspect, that what kind of industry you are. Had you been in mining industry, they would check what are your disclosures to 106. If you are an NBFC, they will check whether scale-based regulations have been complied or not, because that is minimum mandatory things which they need to check. So if you work on all 3 areas, plus your presentation is excellent, plus you have used right visual aids, plus your report is easy to navigate, plus you have forward looking disclosures like SR and how sustainability, everything is coming in place. And lastly, Gauri, did you talk about Tata Steel report to them?
Right. I gave them an example of that.
So our committee is really influenced with the financial teams going on the tech side of it. So as corporate reporting team, as chartered accountants, our thrust cannot be only on the financial part and writing a lot of content. But when Neha is sitting here, she will tell you that how much thrust they give on the visual aids and the presentation of these annual reports on all fronts. So my request is, if you have to excel into the area, please come out of a mindset of just enhancing your financial things and reciprocating it as per Ind AS. Ind AS 38 says, Ind AS 16 says, to come out of that mindset to a mindset what is material to you comes out with an excellent visual aid, with a forward-looking practice. I am telling you that 9 out of 10 times, our research committee will consider you for, as an excellent financial reporting practice, and your report will be benchmarked. So I hope I again feel sorry for joining late, but I hope I was able to justify in the time which was left with us. I am sincerely thankful to Chairman Research Committee and our mentor into this entire process, Dr. Amit Kumar Agrawal ji, because of whom I think we were able to take this session. Else, for a moment, we thought about cancelling it only and making it difficult. But I think the stars of the entire session remains to be Neha and Gauri in the research. Neha in the research committee and Gauri, deliberating on the non-financial, taking it, bridging the gap between both of us, you and me. Thank you once again for this opportunity. Over to Neha and Gauri again to take it forward if you want.
So Gauri, would you like to add anything?
I think thank you so much, Ankit sir, for deliberating on the financial section. Definitely, your input was very valuable in this section. And thank you, Neha, for taking this session along with me. It was good. It was a good experience, I would say. And also Amit sir for adding in between. Thanks a lot.
So I would like to thank both the speakers today, Ankit sir and Gauri, definitely.
You first
for
thank
this
yourself.
Wonderful session.
You first thank yourself for enlightening with your experiences as a reviewer, as somebody who is very closely monitoring this committee.
Right. And I would also like to thank all the participants for giving such a wonderful time today, and definitely Secretary to the Research Committee, Amit sir, for conceptualizing all the entire this series of webinar. Also, the Chairman and Vice Chairman to the Research Committee for their continuous guidance regarding all the initiatives of the Research Committee. So I would also like to mention to all the participants that the next series of this session on the topic of NPO and municipal body is scheduled on 7 July, same time, 2 p.m. to 4 p.m. So, and the speakers would be same, CA Ankit Maheshwari ji and CA Pradeep Kothari sir. So with this, I think we can conclude with today's session.
Thank you so much. Thank you, everyone. Thank you. Bye.
Thank you.